Meltdown, the amazing adventures of Planet Earth and Planet Finance. For about 40 years, banking on Planet Earth was pretty simple. People deposited their savings in a bank called a savings and loan, and the bank would pay them interest and use their deposits to sell mortgages to people who wanted to buy homes. The bank's loans didn't just serve the depositors and borrowers, they actually made economic activity happen in the whole community. Let's see how that works. Here's a homeowner who borrowed some money from a bank to fix her roof. She hires a roofer. She pays him. The roofer pays his workers. The workers spend some of their paycheck to buy groceries. Now the grocer can pay his rent. So when a bank makes a loan, they actually increase the supply of money and promote economic activity in the community. It was a pretty good system, but the system didn't work for everyone. For many years, banks discriminated against communities of color by drawing red lines on the map of certain neighborhoods where they didn't want to lend money. Without access to loans, the money supply shrinks and economic activity also shrinks. That is the situation all of us are in now. Because banking is so important to communities, under demand-side policies, the government had laws that limited what banks could do with people's savings. They weren't allowed to make risky loans. There were limits on how much interest banks could charge borrowers, and banks were required to maintain reserves so they wouldn't run out of money. They were also only allowed to lend in their local community. Then Ronald Reagan was elected and brought in the supply-side era that loosened up bank regulations. In the early 1980s, savings and loans were allowed to make risky loans and gamble with people's savings. We don't have time to talk in depth about the savings and loan crisis, but the upshot is that those risky investments failed, and by the end of the decade, thousands of savings and loans closed all over the country. The death of savings and loan banks left a big gap in the communities of planet Earth. They had to look elsewhere to borrow money to buy homes. They had to go all the way to Planet Finance. So meet Mortgage Lender, a national company that specializes in making home loans. Like Countrywide or New Century Financial, Mortgage Lender isn't a bank where people make deposits that can be used to make loans. So Mortgage Lender has to borrow money. Where in the world is Mortgage Lender going to get the money? Enter investment bank. Investment banks like Goldman Sachs, Lehman Brothers, and Bear Stearns connect the enormous global pool of money that is made up of the hugely wealthy top 1% of the U.S. economy, other economies around the world that have trillions in savings, and big institutions like university and charity endowments, pension funds, insurance companies, and governments. Investment bank connects them with investment opportunities like Mortgage Lender. Here are some of the investors: Mr. Cash, a wealthy CEO, the Central Bank of Brazil, the Teachers Pension Fund, and a state treasury, all with big bucks, looking for a safe and profitable place to invest. So they go to investment bank. Investment banks are not totally regulated and created some wild ways to make money. Two popular schemes are collateralized debt obligations and credit default swaps. Both of these financial inventions played a major role in melting down our economy, so we need to have a general idea of how they work and how they transform lending. Let's whip up a simple collateralized debt obligation. People call them CDOs for short. First, investment bank is going to buy the mortgages that Mortgage Lender sold to homeowners. Investment bank is also going to pay Mortgage Lender a $2 million fee for doing the work to make the loans. Wow! Mortgage Lender just made a $2 million profit and also got millions from selling mortgages to investment bank. They now have megabucks to make mortgage loans. Buy mortgages? Check. Next, investment bank hires a credit agency, a company like Moody's or Standard & Poor's, to rate the mortgages that they just bought. Credit agency runs the big pile of mortgages through all kinds of computer models. They don't look at the individual mortgages. They look at past trends and then rate the safety and soundness of the mortgages as investments. In the process, the mortgages get sliced and diced and all mixed up together. And then they are separated based on risk into bundles called tranches. They issue a different credit rating for each tranche. 3, 2, 1, none. When all is said and done, credit agency gives investment banks mortgages an excellent overall credit rating, and an investment bank pays credit agency $3 million in fees. There you have it. Check. we got our credit rating. We sliced and diced, all in just one very, very complicated move. Next, investment bank creates a special purpose company. It's an independent private company. Investment bank does not own it. It has no employees. It is just a shell. Set up special purpose company. Check. Now investment bank wants to sell the 4 tranches to special purpose company, and they want a $5 million fee. How on earth is special purpose company going to pay investment bank? There is no money in here. It's just an empty shell. No worries. Remember our investors? Each of them is going to make a loan to special purpose company. So that's how special purpose company can buy the tranches and pay investment bank's fee. Investors make loans. Check. So there you have it, a collateralized debt obligation. Nice and complicated. But how do the investors make money? Here is how this system works. Investment bank does not want to be bothered collecting monthly mortgage payments from homeowners. So they hire a mortgage lender to do this. So homeowners pay your mortgage to mortgage lender. Mortgage lender take your fee and pass the mortgage payment on to investment bank. Investment bank administer the cash going in and out of special purpose company and pay yourself a fee for that work. Special purpose company pay the investors a healthy return on their investment. That is one huge transfer of wealth moving from the homeowners to the big investors and the companies that serve them. Notice that the companies on planet finance keep paying themselves. We're not really circulating money around on planet Earth, at least not the way we used to. But we're not done yet. To sweeten the deal, investment bank sells each of its investors something called a credit default swap, which is like an insurance policy. Here's how it works. Investment bank promises the investors that if the homeowners default, investment bank will pay them out of its own pockets. That is just like an insurance policy, right? But there is a difference. An insurance company is required by law to set aside a certain amount of money so that it always has cash on hand to pay off insurance claims. But swaps are unregulated. Not one red cent needs to be set aside for future claims, and even the big regulated insurance companies like AIG is allowed to do this unregulated business, and they did, big time. Because they are unregulated, there is nothing stopping investment bank from selling a credit default swap to anyone at all. Meet hedge fund. A hedge fund is an unregulated mutual fund for very wealthy investors. Hedge fund buys a credit default swap from investment bank. Now, if the homeowners default, investment bank promises it will also pay hedge fund the same amount of money as the other investors. Now let's think about this for a minute. The other investors have good reason to buy insurance. The teachers' pension fund and the state treasury know that they have invested in mortgages and don't want the homeowners to default. But if they do, they have bought an insurance policy so they can recoup their money for their members. But hedge fund has not invested in the mortgages. Their credit default swap is a side bet, not an insurance policy. Hedge fund is doing nothing but gambling. So many credit default swaps are sold that if everyone who had one asked to be paid out at the same time, something like $54 trillion would pass hands. Credit default swaps are yet another layer of potential debt piled up on top of the CDO debt. We are now moving to the last part of our story, the huge housing crisis. No one was worried about homeowners defaulting on their mortgage payments. No one was worried about CDOs collapsing. No one was worried about having to pay claims on credit default swaps. The central myth was that housing prices on planet Earth would rise forever. And from 2003 to 2006, it seemed like that was true, because housing prices were rising faster than anyone had ever seen before. And there was simply more money in the world. Between 2000 and 2008, the global pool of savings almost doubled. There were 34 trillion new dollars looking for places to invest. And companies like mortgage lender, investment bank, special purpose company, and hedge fund were positioned to help them out. Now mortgage lender has lots of money, but they are desperate to find new customers. So where do they go? To the very neighborhoods that couldn't get loans before because of redlining. Here's an immigrant family from the neighborhood. Mortgage lender offers them a subprime mortgage, which is more expensive than a normally priced or prime mortgage. Mortgage lender is acting on the incorrect belief that lending in communities of color is risky business. This family actually doesn't have bad credit and both parents have jobs. They should qualify for a prime loan, but end up with a subprime loan with a low teaser interest rate that can double or triple after a few years. Thousands of people were given subprime loans. African Americans received twice as many subprime loans as whites. Latinos received 3 times as many subprime loans as whites. This is just a new kind of redlining. This time the families inside the red lines get sold the most expensive loans possible. Poor women, particularly women of color, were also major targets for subprime lending. Women in general received twice as many subprime loans as men. 80% of subprime borrowers were taking out second mortgages on their homes because they wanted to buy something like a computer or pay for their children's education, or because they were just having trouble making ends meet. Because at the same time that their homes were going up in value, wages were stagnant and paychecks were worth less than before. As lenders pushed out more and more subprime home loans, demand for houses went up, and so did the cost of homes. In the short space of a few years, mortgage lender and hundreds of other lenders all over the country make tens of thousands of subprime loans. And since they weren't regulated, they could make loans to people who couldn't make down payments or who didn't even have jobs. They didn't worry about it because home prices kept going up. So here on Planet Finance, mortgage lender isn't worried because they're selling the mortgages to investment bank and for a lot of money. Investment bank isn't worried because they are selling the mortgages to a special purpose company and they are making a lot of money too. Special purpose company isn't worried. Well, special purpose company can't worry. It's just a shell of a company full of derivatives that no one can see. The managers of our investors' funds, they're not worried because they have credit default swaps as a kind of insurance. And the real people on planet Earth whose money is in the investment funds, well, they don't even know that their investments have anything to do with mortgages. The scale was staggering. By 2007, subprime mortgages reached $1.3 trillion, covering millions of homes. The housing bubble was caused because Wall Street pumped millions and millions of dollars into the housing market until the bubble simply burst. And that created a lot of our problems today. After a few years, those cheap teaser subprime mortgage interest rates went way up, and a lot of people couldn't afford to pay them. Suddenly, as interest rates increased, thousands of foreclosures happened in the blink of an eye. As thousands of houses flooded the market for sale, home prices went way down. Things on Planet Finance are starting to fall apart. Investment banks and the investors, of course, don't want to buy mortgages anymore, so mortgage lender is stuck holding all the mortgages. It lent out millions of dollars and now isn't getting paid back by the homeowners. So mortgage lender goes bankrupt. In 2007, New Century Financial, the largest U.S. subprime lender, went bankrupt. American Home Mortgage followed. Countrywide would have gone bankrupt if it hadn't been bought by Bank of America. And about 50 U.S. banks, which were also making subprime mortgages, went bankrupt between 2007 and 2008. Now the investors are beginning to get nervous. They watch the market all the time and are glued to the nightly business report on TV every day. They can't believe their eyes. Special purpose company is bankrupt and isn't paying anymore. Don't worry, it's time to collect on the credit default swap. That's what it's for. Oh no, investment bank can't pay. Investment bank is bankrupt too. And this is exactly why Lehman Brothers went out of business. And why AIG, the enormous insurance company that got involved in unregulated swaps in a big way, now needs billions of taxpayer dollars just to stay afloat. So that's what happened. That's how we got into this mess. The moral of this story is that there is only one planet. We are all connected in the economy. And if we're going to work our way out of and keep our way out of this mess, we have to create rules and policies that make the economy work for everyone. How do we do that? Stay tuned for our next episode.